Hello, Hardik.
Hi, good afternoon, Dr. Anade.
Afternoon. So I guess
Yes, we do have all our
yours,
panelists on board now.
we have our other panelists.
Yeah, they all have joined. Hi, Ajit.
Hello, hi. Vishnu.
We'll still just give it a minute more so some of our audiences can tune in. Meanwhile, yes,
Sure.
all our
Hi,
panelists
DK.
are also now.
Yeah, hi. Yeah. Hi, Indranil.
Can you join? Hey, Indranil, how are you?
Hi. So Dr. Dapke was Nandini's HOD, I think in the first 8-10 years at KC
Oh,
College.
okay. Yes.
Indranil's wife is teaching at KC College, Ajit.
No, I'm
I know,
still
I know.
teaching.
Yeah, Nandini.
Same department? Yeah.
Same department, yeah.
Yeah, economics.
Yeah. So that's how we know each other very well.
I'm just going to give another minute for the organizers to let us know whether we're good to go, and then we can get started.
Yes, yes. Is Sagar here?
Yes,
sir.
Sagar
Yes,
is also
yes,
here.
sir. Hello, hello, hi.
Hi,
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 sir.
Sagar.
How are you?
Good, good. My audio is okay, Hardik?
Yes, I can hear you loud and clear. So in the interest of time, let me just quickly walk you through the format of today's session. We have about 1 hour together. To start, I'll invite each panelist to speak for about 10 to 12 minutes, sharing their perspectives on the Trump tariffs. After all three speakers, we will then move into a panel discussion with a few curated questions that will help our conversation progress. And finally, we will open the floor for a live question and answer session, which will be about 10 to 15 minutes, where we'll take questions from the audience. Hence, members of the audience, please feel free to drop your questions anytime in our chat box, and our team will be happy to pick them up. Our aim today is to keep this discussion insightful yet very accessible. We understand that not everyone in the audience may have a deep background in trade policy yet, and that's perfectly fine. We'll try our best to explain any technical terms or concepts as we go along. By the end of this session, we hope you'll walk away with a clearer picture of what Trump's tariffs were, why they've been implemented, and how they continue to impact the US, the global economy, and countries like India. Okay, so are we good to go?
Yep.
Yeah, I think we can begin now. Good afternoon, everyone. Thank you very much for tuning in. I'm Hardik Doshi, Chief of Staff to the CFO at White Oak Capital. I'm truly honored to be here today and want to extend my heartfelt thanks to the Meghnad Desai Academy of Economics for inviting me to moderate this important conversation. So today's topic, the Trump tariffs, has once again taken center stage in global trade discussions, from the 2018 steel and aluminum tariffs to the latest developments just this past week. These policies continue to reshape global supply chains and economic relations. Most recently, the US has announced sweeping tariffs, now revised to a baseline 10% on most imports and up to 145% on all Chinese goods, with a 90-day pause for many other countries. The ripple effects of this are being felt across markets and sectors. India, initially stated to face a 26% tariff on its exports to the US, now finds itself in a critical negotiation window. The Indian government is most likely actively pursuing an interim trade agreement with the US during this 90-day pause, aiming to mitigate the potential economic impacts of the tariffs. While India has refrained from any retaliatory measures, the broader implications of these tariffs could influence investment patterns and the cost of imported goods within our economy. So before we dive in, let me introduce our distinguished panel of experts who will help us make sense of this complex landscape. First up, we have Dr. Ajit Ranade, an eminent economist and columnist. I grew up reading his column in Mumbai Mirror throughout my childhood. He is the chair of the academic board at MDAE and the former vice chancellor of the Gokhale Institute of Politics and Economics. Dr. Ranade also served as chief economist at the Aditya Birla Group. He is co-author of the book Rising to the China Challenge and brings a nuanced, long view perspective on global trade and China that will be invaluable for our discussion today. So thank you, Dr. Ranade. We're very honored to have you. We also have Mr. Dharmakirti Joshi, who is the chief economist at CRISIL, an S&P 500 S&P global company and a board member at MDAE. With over 35 years of experience in economic research and forecasting, Mr. Joshi has worked with institutions such as NCAER and the Central Electricity Regulatory Commission. He's an expert in macroeconomic trends and public finance, and we look forward to hearing his insights on the broader economic impact of these tariffs. Mr. Indranil Sengupta is currently professor of economics at Shiv Nadar University. He previously led the India Research Center at CLSA and Bank of America Merrill Lynch, where his teams consistently rank at the top in investor surveys. He also served on the government's Working Group for Wholesale Price Index, WPI revision, which is a critical inflation benchmark. Mr. Sengupta brings the rare combination of academic depth and market expertise and will help us understand the real-world impact of these trade measures. We're honored to have all three of you with us today, and thank you for taking the time to share your expertise with us. We'll now get started with our question and answers. My first question would be to Dr. Ajit Ranade. Could you give us an overview of Trump's tariff policy and its broader economic and geopolitical implications, especially regarding the US-China trade imbalances, since you're clearly an expert on China?
Thank you, Hardik. Just to make sure that you can hear me clearly.
Yes, I can.
Thank you for the kind introduction, and I'm delighted and privileged to join this panel along with Mr. D.K. Joshi and Mr. Indranil. I will take a few minutes just to make my opening remarks. Firstly, I'd like to say that what is being called as tariff action or reciprocal tariff or a trade policy is, in my mind, driven by the desire to target or tackle China, especially, and the geopolitical challenge of a rising China. That we should be clear. That's, I think, that's the overarching objective of President Trump. Secondly, you have to understand that the global trading rules, which were codified in the formation of the World Trade Organization in 1995, were based on two foundational principles. Two foundational principles are called MFN and market access. MFN is most favored nation. I mean, it's just a technical term, and market access. MFN just means that you cannot charge different tariffs to different countries. If you're allowing a country to import at a particular tariff, that same tariff should be applicable to whoever is wanting to import in your country. And market access means that once a good is imported into your country, it should be treated the same as a domestic good. So no distinction between a foreign import and a domestic good. Now, these are foundational principles, but clearly what Mr. Trump has been saying seem to contradict foundational principles of WTO. So I just want to say that Mr. Trump's actions are actually also kind of a deadly blow to the foundation of WTO. Perhaps it is time to reform WTO. So that's the second point in terms of global multilateral governance, multilateral institutions, and the role of WTO in being the arbiter or the neutral referee that guides and develops global trade. Second point. Third point is that the US, if you look at the position of the US in the global economy, in terms of trade, I think it is about maybe 10% of global trade. In terms of GDP, it's about 25% of global GDP. In terms of clearance, the dollar, the payment clearance, it's about 60%. And in terms of trade invoicing, that is, invoicing of imports and exports, it's 90%. It's very high. So there is an exorbitant privilege to being this economy or this currency, which has a large share of invoicing and large share of dollar clearing. I just want to mention that because that is a position now which may not, be taken for granted. So I think the geopolitical motivation of the US is driven also by a concern that its position as shall I call the dominant position geopolitically in terms of clearing, invoicing, and so on, may be under threat. And that's why Mr. Trump made a reference that he said that if the BRIC currencies started invoicing in each other's currencies or trading in each other's currencies, he would slap a very punitive tariff against their exports. So there is that element of the US wanting to protect its status as a dominant financial power. My fifth point relates to this philosophy which seems to be behind the Trump administration's thinking. He famously said that just like we have the Internal Revenue Service, I'm going to have the External Revenue Service. What he meant by that is that the US is the largest importing country in the world, and it imports goods and services from all over the world at fairly low tariffs. So he was implying that the world has free access to our consumer market, but the Americans, when they try to export to their respective countries, they face tariff barriers. That was the beginning of his discussion on reciprocal tariffs. But what Trump wanted to say is that we are going to use these import tariffs. We are going to hike import tariffs on imports from other countries, and the import duty revenue that we will make will actually replace some of the internal revenue, so the tax system in the US. So basically, the goal, at least articulated, was that we are going to collect now fairly large quantities of import duty revenue, and that will replace, we will reduce domestic taxation, income tax. Now, that is not as outlandish as it sounds, because the United States, from its independence in 1776 all the way till 1913, which is 127 years, did not have income tax. The main source of revenue for the federal government was import duties, in fact. And the first Secretary of Treasury, Alexander Hamilton, was very, the strong votary for these policies that what we call today mercantilism. Of course, it was not as if other people didn't oppose it, Thomas Jefferson and others, but this continued for a long time. So it looks as if, the Trump team is influenced by that kind of thinking. But of course, the world is very, very different from 1913. In 2025, global trade crisscrosses boundaries. Global trade consists of complicated global value chains. The iPhone that we take great pride on exporting out of India has components coming from multiple countries. And in fact, any particular good which is produced, whether it's iPhone, whether it's footwear, whether it's textiles, crisscrosses boundaries many times so that the value chain, I mean, every time you cross a boundary, if you're going to pay import duties, it's going to be very complicated. So, so the world is very different from 1913. So I'm not sure this thinking, because what the Trump team was saying, that we understand that raising import duties will make it expensive for the Americans, and we will replace it. We will compensate by reducing income tax. That's not so simple. So that's the politics of it. Last point I'd like to make is that you see the tariffs were introduced on 2nd of April, and then there was this tit for tat actions. Initially, the Canadians retaliated. I think the Europeans also made some retaliatory noise. But then very quickly, we had this tit for tat action between just America and China. So much so that I think in a few days, literally, of tariff escalation, Mr. Trump has given a 90-day reprieve to everybody else. He is saying that the tariff on import duty on Chinese goods is going to be 145%, and China retaliated by saying import from America is going to be 125%, but everybody else gets a reprieve. So this, the interpretation of this is of two kinds. The people who support Trump feel that it's a masterstroke because he has been able to isolate China in the world community, trading community. But the other contrary view is, in fact, Mr. Trump capitulated by giving a reprieve to everybody, all other nations. It is an admission that this tariff strategy is not working, and it might have a backlash. Indeed, the bond markets actually collapsed, and some of this might have influenced Trump's actions on reverse. So I'll stop here for the timing, and we'll come back later. Thank you.
Those are priceless views. Thank you very much. You've drawn important attention on how the strategy isn't just economic policy, it's a fundamental challenge to the post-war global trade order, and undermining WTO's principles also, and positioning the tariffs as a tool to counter China's rise. The US is clearly signaling a strategic shift. And your historical reference to America's pre-income tax era, where import duties were the main source of federal revenue, offers a very, very fascinating lens to understand this external revenue service proposal and how it could reshape US tax structures and trade relations. Now, my next question will be to our next speaker, Mr. Dharmakirti Joshi. From a macroeconomic standpoint, what are the short and medium-term impacts of these tariffs on growth, jobs, inflation, and global supply chains? And what are the long-term implications for countries like India in terms of export competitiveness? Sorry, I'm going to have to ask you to unmute yourself.
Yeah, can you hear me?
Yes, I can hear you loud and clear.
Yeah, so I think the couple of things. I think first of all, thank you very much for having me here. I also want to, I think, add a few bits to what Dr. Ranade said, which is, I think it's this policy package that they have put forth, I think, has three elements. One of them is the tariff, and the idea is, as Dr. Ranade was saying, to collect taxes and then redistribute them. But I think there are two other elements which are less disruptive, so to say. One is that I think he wants to cut the tax rates in US. I think there's some progress there. And third thing is he wants to deregulate. So the first part is the tariff part is contractionary in nature, but the tax cuts and deregulation are supposed to prop up economic growth. So what we are seeing right now is the first part, not the growth inducing part. So that's number one. Number two, I think in terms of impact on growth, inflation, and other macro parameters, I think the scenario is still playing out. I think we do not have the new equilibrium, so to say. I think it's continuously evolving, and so it's very difficult to point out what is going to happen. But yeah, I think the economists haven't given up churning out numbers. WTO, for instance, I think a couple of days back talked about what the US-China tariff is going to mean. I think so. I think on April 10th they came out with some estimate that the trade between US and China could decline by 80%, which is massive. I mean, and also I think the repercussions of that for the global growth would be that over the long term, world GDP would be lower by 7%. So I think long term means I think it's a basically one should take them as directional. Precise predictions are very difficult at that time. At this juncture. Now coming to the three major economies, I think, which is one is US, the second China, and third, let's take India in bit because India is, I think, we are bothered about India as well. So I think in terms of growth, the US growth is expected to go down. I think there is a downside to whatever estimates exist currently because of the tariff changes. The Chinese growth is going to go down even further because US is still a domestic-driven economy. China is, I think, very hugely dependent on exports. I think they run a trade surplus of close to $1 trillion. So Chinese growth is going to slide much faster than the US growth. But inflation is going to move in different directions. The US inflation is going to move up. And I think one estimate by S&P Global was that by the fourth quarter of 2025, inflation could touch 4%, which is above the Federal Reserve's targets. And then I think coming to China, China is already in deflation. I think their PPI, their consumer price, I think they are all deflating, and the deflationary pressure is going to rise because what's going to happen is if China is not able to export to US, they will end up with excess capacity, and the excess capacity means that that they will have a downward pressure on prices, and what that means in other terms is that I think they will have a lot to export to other countries at lower prices, which is called in simple terms dumping. So that I think risk arises out of this dynamics of growth inflation. And then I think the third is monetary policy. What happens to monetary policy? And I think the US will try to balance growth and inflation targets or growth and inflation objectives. It's very difficult to say. I think if the recessionary pressure rises, then you will see more rate cuts. But if economy does reasonably well and inflation keeps rising, then the Fed will be on the cautious side. So it's still evolving, I would say. Whereas China would be easing. I mean, they have to prop up growth, so they might use fiscal policy also. So now coming to India, I think the monetary policy is going to be easy because inflation risk has come down in India. Monsoons are predicted to be normal, so food inflation is likely to remain soft. And the biggest advantage of this adverse development is that oil prices will come down. So your current account deficit, your inflation remain under check, whereas growth gets a boost up. I mean, that's, I think, the most of the calculations done on how the oil prices impact the macro parameters show that it's beneficial for the Indian economy because 87% of the oil is imported. So if oil prices remain soft, it helps us. So I think monetary policy will remain easy, and I think the rate cuts are likely to continue. On the growth front, I think it's too early to say how much you will end up with. Our current forecast at this juncture is around 6.5%, and we are going with the guidance that there is a downward tilt to these numbers. So what actually plays out will depend on how much tariffs you eventually get, what kind of a trade deal we are able to do, what kind of knock-on effects this tariff TIF has on our trading partners, because one is that your exports become expensive for the recipient country. At the same time, their incomes go down because if GDP growth slows down, I think so. All these things are still, I think, evolving. So it's very difficult to give you a very pointed number as to where the growth will land. But I think India is not that much impacted because, like the US, India is also a domestically driven economy. And I think the exports to US are lower than 3% of GDP. So I think in those terms also, it's not a big shock. It doesn't look like a big shock at this juncture. But I think the one casualty of all this is going to be investment decisions, because I think people want some certainty on the tariffs, on some growth prospects, etc. Right now, when the situation is fluid, they will postpone investment decisions. And in India, I think it refers to the corporate sector, which has not been investing very aggressively anyway. I think so. There'll be further delay, I think, as far as the investments from the corporate side are concerned. And this goes for the entire world. The FDI flows will also slow down until the time you have some sense of where all this is settling. I mean, so that's, I think, maybe I should stop here, and I can keep going on, because there are a lot of things to say. But let me stop here, and we can come back again.
So I have a quick follow-on question for you.
Yeah.
Assuming you're a young entrepreneur with an economic policy background, what would you be? Do you see immediate opportunity today? There's a lot of talk about how Indian suppliers should be contacting companies in the US who are importing from China, offering alternatives. Do you think this is a quick period where, they always say that whenever there is a large atrocity of some kind, there's also a large opportunity. So do you look at it as something that is actionable if you were a young entrepreneur today?
I think I would keep my eyes open to the developments, but I think I would also be extremely cautious at this juncture, because things have not stabilized. You don't know what kind of deals are going to emerge eventually on trade. I think individual bilateral trade negotiations are taking place. So you have to keep your eyes open and look for opportunities, but at the same time, I think you'll be taking a decision in an extremely uncertain environment, which I think maybe if I were there, my appetite would not be that much for plunging in at this juncture.
Okay, fair enough. So from India's standpoint, we must have like a cautiously optimistic outlook,
Yeah.
and a normal
That's right.
monsoon, softening oil prices, easing current account deficit. These pressures might support growth, even though it's too early to quantify how much of this will immediately
Yeah.
come to India.
True, but I think
So,
if I may quickly add, or
yes.
maybe I can add it later on, but I think there are some buffers that India has, which usually you don't talk about. But I think only when the buffers don't exist, then they make noise. I mean, for instance, if your current account deficit is low right now, your corporate balance sheets are extremely healthy. I think so. Maybe I can talk about that later. And at the same time, inflation is coming down. So if these were opposite, I think the newspapers would have been full of how vulnerable we are. But I think these buffers also cushion us against the shocks. They can't completely offset the shock, because it's a big tsunami kind of a shock. You'll be impacted, but if these buffers were not there, you would have been impacted much more.
Yes, so perfect. Thank you. I think as Ray Dalio famously says, pain and reflection often leads to progress. So maybe that's something that entrepreneurs across the world need to do at the moment. Thank you very much for summing things up and helping us understand this topic from a broader macroeconomic lens. I will now move to our third speaker, Mr. Indranil Sengupta. And my question to you is, how have investors and markets reacted to the trade war initiated by this tariffs? I know it's still very early to say, but what do you think are going to be the far-reaching consequences of the same? Again, to put this question into context, in your long career, you've seen a lot of ups and downs, the big cycle, again, as Ray Dalio used to say. Do you have any inputs, any advice on what you see in terms of overall policy, and then applying that to the markets?
Yeah, first of all, thank you for inviting me. So I think that I will talk about three angles. One is obviously whether the tariffs are yesterday's news or not. That is number one. Number two is that, how do they impact the US economy? And number three, what happens to India, especially given that we have already sold $100 billion of FX reserves. So, right now, everyone will have to wait and watch, because, there is no point for any country going and making a trade deal and then finding out that, Trump has not been able to impose tariffs on anybody else. So rationally, every country will play along, but not really pull the trigger, right? Because you don't want, this is one of those places where you don't want to go first. Now, will President Trump uh, be in a position to resume tariffs, or is it just that you say something before you get out and say 3 months time and look, I'm doing this to China, is something that we have to wait and watch. So I think that markets therefore will continue to be volatile and play it by the year. So every data point that comes in will lead to large swings in the markets, as is happening. So I think that there are certain, uh, I would say, certain uh, parameters that tell you that this was not a very well thought out deal step. How can the trade deficit be a proxy for tariffs, et cetera, et cetera? And then this gets withdrawn. So I think there is that much of a trust deficit between the markets and policymakers that's going to grow. So I think that markets will remain choppy, and it's not the equities market now, because you also don't know whether China and Japan will want to dump US G-SECs. So that has become an additional dimension that we have not seen in the past. In the past, it's always been about equities, but this is something that goes and affects the bond markets as well. So that's one. Number two, I would say that the big question for the US is what is the macro impact? I think it's relatively easier to evaluate the impact on inflation and growth if the tariff policy were to stay. But now you are in the realm of trying to forecast the impact of uncertainty on what decisions people take. So as you can see that most houses had a recession probability of 20%, and they ratcheted it up to 50%. Now at least one big house has brought it down to 35%. In other words, no one knows what's going on. Now, does that mean that there is going to be an impact on the way people make decisions, and will that have knock-on effects on the markets? That's something the markets will see. It's just not the tariffs. There is also a widespread sacking of government servants that had begun. I think it went up to 200,000 almost. Today I saw President Trump has come out with a statement that he doesn't need Elon Musk, but it's just that he likes him. So what does that mean? These sackings stay or these sackings go? And what would probably happen if people actually lost jobs at this scale is that everyone will begin to shrink their consumer decisions. Obviously, you don't know whether you're going to be on the on your job or not, and you are having army generals being moved out saying that you are a woke and stuff like that. So I think that this is another angle, the hit on consumer confidence that markets will have to grapple with. So overall, I think global markets will remain choppy, and they will wait to see what is happening. Before this step, I think a lot of commentators were of the view that the only person Trump will listen to is Mr. Market. If Mr. Market shows anger enough, Trump will back down, right? Now that has happened. But for the revival, the midterms are somewhat away. So is it the popularity poll results that he will see? Because of the three, the market is kind of now, I think in a way the market feels that the tariffs are gone, and it's just a matter of time before Trump backs out on China. But is that the scenario or not? I think is something we have to wait and watch. And like I said, what happens with US G-SECs held by China and Japan. Coming to India, I think that we are in a situation where there has been a slowdown. Our inflation was never a problem. I think talk about inflation just serves as a proxy for the fact that the Fed has kept rates high. And at the same time, we have sold $100 billion of FX reserves, which is a bit unusual for the RBI because the RBI typically does not fight a strengthening dollar. Now, what this means is that we are not as strong as we were, let's say 6 months ago, 9 months ago, to a global shock, right? So that's number one. Number two, I know that India exports barely 2-3% of GDP to the US, but let me tell you a story. In 2008, we all calculated, I used to be at Merrill at that time, and we all calculated that Asia barely exports to the US. India exports 2% of its GDP to the US. So we had this theme of Asia decoupling. I had written a report saying bloody but unbowed. And I said that, look, since 2% of GDP goes to the US, even if that turns to zero, we'll lose 20 basis points of growth. Growth will come down from 9.1% to 8.9%. And guess what? Growth actually fell to 3.5% because what happened is, there were multiple channels, many countries slowed, and it's just not trade. Financial markets crashed and so on. So I think that, at that time, I remember a rival house used to say that 2008 was going to be a happy recession. And we all saw how happy that was. So I think that we need to wait and watch what happens on the first two fronts. For us in India, obviously, the fact that we are a relatively more domestic economy will mean that we have buffers. But then, we are relatively more vulnerable than we have been in the past. And indeed, if inflation keeps the Fed rate high, there is very little the RBI can do to support growth by cutting rates. I think even when the RBI cut on Friday, the rupee reacted, and this is when the dollar is weakening. So I think that the RBI's ability to support the economy at a time if the Fed is stuck is also going to be challenging. So I think on the whole, I will say that these are tough times, and no one should, try to see the glass as half full rather than half empty. These are, there are times when you think everything is done with, there are times when the knife is falling. So I would say that this is a time when, one shouldn't rush to catch a falling knife.
Okay, wonderful. No, one should not rush to catch a falling knife is a wonderful summary to give to anybody, especially even as advice in general to a lot of the young folks watching in here, because I'm sure everyone is tempted now. It's super easy to also trade and invest in today's world, which is why it's a very important thing that my generation also sees a fall once in a while, because I think my entire generation has not seen a significant economic, ever since we've had money at least, has not seen a dip in the stock market. And then the whole concept of stocks only go up is now taking a real beating. So thank you, Mr. Sengupta, for that sobering and nuanced perspective. You've reminded us that while it's tempting to react quickly, we are still in a wait and watch territory. Markets are volatile. Lots will depend on what deals are struck behind closed doors. And I think you raised a fair question in terms of the formula that was used by the US government to calculate the tariff rates for countries about should trade deficits really be the basis for setting tariff levels. So, and I'm sure the penguins in the islands near Australia also agree with you, who have been given tariffs of 10%. So we can now move to our curated questions. But before we jump into that, I would just like to ask all three of our panelists if you have any specific points you may want to raise, considering you've listened to what the other speakers have spoken. Maybe
Well,
Dr.
I think
Joshi,
I
you
thought
want to
I.
speak? Yes, go ahead.
So, can I come in, Hardik?
Yes, please do.
I'm just actually looking at the chat box, so I want to straight away jump into that question.
Let's do
There's
that.
somebody, I think Ridhima Gupta, because we have only 20 minutes left, so we should go there. Is it Ridhima Gupta and someone else about BRICS? So you should understand that the BRICS formation, which is started off with Brazil, Russia, India, China, and then you added South Africa. That's why it became then BRICS. But now the collection is about 14 countries, I believe, and even Pakistan is knocking on the door. So potentially, this is a formation which, as I said, the US dominates the financial system, the payment system in the world of dollar clearing. So even if a Saudi sheikh is buying a Toyota from a Japanese manufacturer, so the Saudi currency is not dollar, the Japanese currency is not dollar, but the transaction, the deal, the invoicing is done in dollars, and often the payment is done in dollars. That whole system can be threatened if the BRICS, the formation takes place. And that is something I don't know if you have enough time in this today's session, but that has given an exorbitant privilege to the US, not to forget the seniorage tax that comes from having a large part of its cash in circulation in the outside world. So that is what Mr. Trump is focusing on. And I don't know whether there is enough enthusiasm between the BRICS countries, the original four, because they are very different from each other. Brazil, Russia, India, China are completely different from each other in terms of economic systems, in terms of their core, strengths, in terms of what they export and import. But I believe the Chinese are taking lead on the digital RMB. And if that, the sort of Bitcoin or blockchain technology-based cross-country, if transaction can take place and payment mechanisms are emerging, that can be a serious threat. But these are early days. So my answer is immediately the BRIC formation is not in any, imminent state of introducing intra-BRIC currency, new currency, but can't be ruled out. And more countries now want to diversify. The top 5 or 10 countries which are foreign exchange want to diversify away from the dollar assets because they are losing value. And we saw the confiscation of Russian assets of $300-400 billion in the wake of the invasion of Ukraine. So this trend is inevitable, diversifying away from the dollars.
Yes, please go ahead,
Yeah,
Mr.
just
Joshi.
one quick point. I think I want to make sure that is not missed out. I think when we look at the impact on the economy, I think apart from the buffers, etc., I think one reality is that unlike many other countries in Asia, I think India's about 50% exports are services. And the tariffs are on goods exports. The US runs a trade surplus on services, so it's not likely to touch them. Now, what we looked at the data on services exports, how they have been growing. I think it used to be 30% of total exports, maybe about 15 years back. Now it is 47% of total exports. So the share is rising. And if you try to correlate it with the global trade cycles, the goods trade is very synchronized with the global trade cycle, whereas the services trade has its own secular movement. So it's been going up only. I think you look at the GCC story, etc. It's changing its nature, and people are even talking about now supply chains and services, etc. So I think I just wanted to make this point that is also one of I think something that in some manner cushions your hit. I mean, because services, we have seen in the previous downturns also, services exports don't get impacted that much.
I just
Very
want to
valid
add,
point.
I think this very important point, which very important point that DK has made. The number one item for India exports is software services, almost $200 billion. The number two item for India is remittances, $129 billion. Together, these make up almost $400 billion of export earnings, dollar earnings. And these two are what Mr. DK said are not likely to be affected. But I'm slightly differing on the first point because software services, even today, depend almost 60-70% or maybe higher on the US market. And if the US experiences a recession, that is a threat to our software services industry. When I say software services, I'm including everything. not just IT and IT-enabled services, but the global capability centers, the LPOs and the BPOs and all that, everything included. But if the US goes into a recession, that will be it.
No, sure. I think a point I was making is services are less impacted than goods. I think that's the
Yeah.
Correct.
and they cannot be subject to
point
tariffs
noted.
because unlike goods, they don't enter your border. I think so. They sometimes enter your country via cyberspace. It's not very easy to.
Yes.
Fair point. But just to add there, I recently read a report about how Tata Consultancy Services has even delayed all their appraisals for the year. Salary hikes for the year have been paused. In the last quarter, they have hired only 625 employees. And considering the fact that they have 6 lakh employees, that is a huge slowdown already that they are facing. So again, I think everyone's in a wait and watch state. One of the questions we have received is also that do you see any expected impact on any startups in India who may have received funding from the US and maybe some that are also dealing with China in terms of procurement?
Yes, I'll jump in here. Yes, actually, there is great degree of uncertainty. See, investors want predictability, continuity, and stability. The worst thing that investors do not like, that they hate, is uncertainty. And we are in a period of great uncertainty. Even when there was a hearing going on in the US Senate, the Republican senators were sitting there and they were defending that no way the tariffs are going to change, no way. And while this hearing was going on, there was a tweet from President Trump saying that he's actually giving a 90-day pause. The Republican senators who were answering the hearing, they didn't even know that. So things are changing too fast. So investors are going to be very cautious. So the startups have to factor in the fact that some of the funding may get postponed, hopefully not cancelled. And in fact, many hiring decisions are also being put on hold, especially of companies which have an export exposure to USA, especially textiles, electronic parts, auto components. Hardik, I want to just quickly take this point
Yes.
from Xerxes, who said that Apple loaded 5 aircrafts filled with iPhones before the April 9 deadline and rushed them from India and China. That's the reason is an average iPhone costs $500 or $550. If the tariffs had were applicable, that price would jump to $800. So they didn't want, and it's a very highly visible item. So they wanted to maintain that price tag and not immediately have to revise the price tags after the tariffs came in force. That's why, to avoid that, they have loaded up the inventory of iPhones in the US hugely. And they want to continue to sell those iPhones at the lower price tag. But now, after the tariffs come into play, they can legitimately raise it by 100%, 125%.
Okay, perfect. I have one question which I'm going to club a couple that were asked by Saundarya and Vishakha. If the next 4 years of the Trump administration continue like the past 2 months, what do you think the future trade relations could be like? Could we be leading away from a US-centric world economy?
Well, can I jump in? I know DK works for an American company,
no
so his comments are going to be a bit guarded. And Indranil used to work, but now not anymore. So if you can't predict what's going to happen in the next 24 hours or next 72 hours, it's unfair to she's asking us to predict the next 4 years or 3 years. It's a very unusual, unpredictable territory. And, Indranil said that the only thing that Trump will listen to is Mr. Market. But you know what? The market went up. I mean, it went down and it went up again. And now there are allegations from Democratic senators that somebody has made a huge hundreds of billions of dollars in insider trading profits. So we are actually dealing with very uncertain, volatile situation. As economists, I hope we'll agree. I mean, DK and Indranil, that this is not clever policy. This huge increase in tariffs, this sudden action, no lead time to adjust. This is simply not good economic policy, because policy making has to respect. I told you, investors like policies which are stable, predictable, and there has to be a continuity. But what we are seeing is really a drastic action. But as I said, the reason is that the US now wants to start. Well, I don't know, it is doing it rather in a rush, but basically they have to start taking on the fact that the rising China is going to pose a big challenge to the dominant status that the US has enjoyed all these years. So I think that's where this confrontation is coming on. We had this Cold War after the Second World War. We had a Cold War between the Soviet Union and the United States, which ended up in the breakup of the Soviet Union, and that was because of an arms race. They basically bankrupted the Soviet Union and the Russians. But this is now Cold War 2.0, which is all going to be about cyber, about trade, about dominance in high technology and space. So this is a very different kind. There's no bullets need to be fired, no missiles need to be fired. Different kind of Cold War.
On a lighter note, if I may just add one line, I think the speed with which I have to change my presentations these days is not funny. I mean, so you make a presentation in the evening, and while going to the client, you are revising it because something has changed.
No, absolutely. Very quickly changing world order. And another interesting question we have from Ketan Upasani is, beyond the immediate impact of export volumes, how will Trump's tariffs affect India's long-term industrial diversification and its pursuit of Atmanirbhar Bharat, especially in sectors like pharmaceuticals, electronics, and manufacturing? So I think he's also trying to capture that. Do you see a large shift of India capturing the contract manufacturing market, say for pharmaceutical APIs, electronic part manufacturing? Because it is a well-stated fact that I think in the US, immediately, at least, those manufacturing capabilities do not exist for a lot of these products. And setting that up will have a significant lead time as well as very high cost involved.
So I'm going to say a few lines and I will let DK answer because he's the real specialist on these topics. But you see, earlier in the program, you asked, should some companies go and make a dash to the US and take advantage of this differential tariffs? Today, India's tariffs are lower than Bangladesh, Indonesia, Vietnam, even Sri Lanka. Forget about China. China is very steep. So a company like Wellspun, it supplies the bulk of the towels that go to companies like Costco and Walmart and so on. So surely this should be, they should just ramp up. This is an example where if it's possible to ramp up capacity, you just double the volume of exports to the US and your tariffs are going to be much lower than the others. So you have a competitive advantage. Same thing about because of the China huge tariffs, India can take temporary at least advantage of rushing in and filling that space, which will be either vacated by China or it will face a huge competitive disadvantage. How much of it is possible to overnight ramp up capacity is a different question, and I think there will be a limitation there. We also, it is going to be a big shot under some duress and under kind of a gunpoint pressure to start building up the bases, for APIs, like you said. One of the big ingredients in the pharmaceuticals is a generic drug called paracetamol. I'm told that paracetamol, we virtually, declined in production from India because it's cheaper to import from China. Here is an opportunity to start rebuilding. In fact, I believe it was penicillin. Penicillin was discovered in the 1940s, and one of the first penicillin factory came up in India in the early 1950s. But thanks to the Chinese competition, everything closed down. So we have to get back to producing things which we used to produce. And in a way, as DK also said, since India's economy has a large domestic component, this opportunity of this tariff disruption and it should be used to actually pursue reforms domestically. A lot of reforms need to be done, whether it's in the agriculture sector, in textiles, in labor markets. I think that there's a lot of action that needs. We should push it domestically. But DK, probably you can add something.
Yeah, I think so. Just at a very 36,000 feet level, if you plot India's GDP growth for the last 40 years, and on the same chart plot the advanced countries, OECD countries' GDP growth, you will notice two things. One is that in the last 2 decades or so, the growth cycles have got remarkably synchronized. So, which essentially means that any short-term pain in the West very quickly transmits to us because we are trading more, financial markets are interconnected. That's easy to understand. But the moment you try to have the trend lines in those cycles, you'll see that trend lines are diverging. India's growth has been moving up over an 80-year or 40-year period, whereas the advanced country growth has been coming down. And the reason why that has happened is because we've activated our domestic triggers. I think we started the reforms in 91. Some or something or the else happened, which raised our growth potential. And there's plenty to do there. I mean, that field is quite barren. I mean, there are so many things that you can do and push your ability to grow, starting from better infrastructure, more R&D, labor reforms, you name it. I mean, there are many things that you can still do to raise your potential. So that's number one. Now, coming to the manufacturing side, see the immediate impact when we look at our ratings folks, when they look at how the sectors are getting impacted, they look at three things. One is the volume effect. I mean, so volume effect for a good that can be replaced very easily will be very high. For instance, I think for pharmaceutical, it will be low. It's not so, it's a critical thing. So it is going to take time. So what is the volume effect for that? Then there is price effect. Can you pass on those costs to the American consumer? Or will you have to take a cost? So if you take a hit, then your revenues, margins, everything gets impacted. And finally, then the other element is the dumping that comes from China. I think if that increases, then so that's also going to impact your margins and many other things. So I think a combination of these three things are going to decide how things play out in the near term, I think, which is maybe a year or so. But beyond that, I think it is a story of competitiveness. I think you have to become more competitive to capture. I think the tariff differentials will only help you to some extent. I think they will fade away after some time. So, and there, I think you need better logistics, you need lower electricity prices, you need flexible labor laws, you need which government calls deregulation now, and decriminalization of laws. I think all those things become very critical from a longer term perspective, because people will eventually buy from places which are cost effective. And that the gain comes from efficiency improvement, for which you have to do reforms. I hope that answers. I mean,
yes, I think that extensively answers the question. There are still a lot more questions, I think, in the chat box, which have been addressed.
There's a question from Aditi Verma, who says that historically, how do these tariffs compare with historical rates in the US? There is no comparison. These are unprecedented. We've never had this kind of 100, 150%. This is unprecedented. That's why it's uncharted territory.
Perfect, gentlemen. Any closing notes from all three of you?
I think we need to give time to Indranil. He's been silent.
Sorry, I'm going to have to ask you to unmute yourself when you can.
I think we can give some time to Indranil and then maybe.
No. It's just that there is a question on what to do in markets for the time being. I think that, like I said, that it's better to avoid catching a falling knife at this point. But if you must, I think it's better to be in domestic plays, barring autos, because in case we see some kind of a cut in import duty on EVs, the auto sector is going to sell off very badly. And there is nothing called a graded cut that you will start cutting today and go to 2030, because then no one is going to buy a car right now, or at least an EV right now, because you buy the car expensive and after 5 years you'll have to sell it very, very cheap. So I think that pure domestic plays minus autos is probably the place to hide at this point in time.
Perfect. Anything else from our other two speakers?
Okay, I want to take just a couple of questions. Aditi, again, she asked, how have Biden's policies differed from Trump's in terms of tariffs? Well, Mr. Biden continued the policy against China, by the way. Both Biden and Trump had the same stance when it came to China. But Biden did not increase tariffs for other countries. And he certainly did not have a reciprocal tariff regime. And nor did he kind of try to destabilize the WTO system. That's a big difference. There's a question from Mahima. He says that contrary to what you mentioned, tariffs in India being lowest, all I was saying is that the import duty on goods coming from India are going to be at maybe 20%, 26%, whereas the other countries is much higher. That's the only point I was saying. There's a differential advantage. That doesn't mean that there are no other disadvantages might be there. And by the way, everybody's got a 90-day reprieve. So, and then there's a question saying that why is there a Cold War with China and not somebody else? Because the US is worried. The rise of China is worrying to the world. The rise of India, by the way, is benign. People don't get scared if India becomes a $5 trillion economy or 10. But the rise of China is somehow seen as discomforting. I mean, we can have a separate session on that. But in closing, I'd like to say that these are very unprecedented times, and policies are changing in real time. They're kind of violently reacting to changes in the markets, financial markets, especially stock markets and bond markets. And in the meantime, companies have to make plans, investment plans, employment plans. Students who are trying to be in the job market, their job offers are being retracted. So these are very turbulent times. So it's going to be a challenge for our own policymakers. We can take refuge in the fact that India's economy tends to grow at 5-6% because basic structural factors like demography and urbanization, and we will hopefully continue that momentum. And we will use this crisis to pursue very aggressive reforms that have been pending for quite some time.
Great. Thank you. Thank you very much to all our speakers for helping us navigate this complex web of trade, tariffs, and geopolitics. What we've heard today is clear. Trump's tariffs are not just about economics. They're more like the tremors before a potential tectonic shift in the global order. Some see protectionism, some see strategy. For countries like India, it may be both a risk and a runway. And in a world where every trade policy can ripple across continents, are these tariffs just short-term political noise, or are they the notes of an early new global symphony? Is this the noise of a changing world order? Only time will tell. So thank you very much again for joining us, and I hope today leaves you curious and more well-informed. Thank you very much to the Meghnad Desai Academy of Economics for hosting this engaging session, for bringing such distinguished speakers together. And for any young students who may have any further questions, please feel free to reach out to anyone within the Meghnad Desai Academy of Economics. They're all super receptive and helpful. Any queries that you may have, any further learning you may want to do, please feel free to reach out, and I'm sure they'll help you out. So thank you. Thank you once again.
Thank you, Hardik, for hosting it. Thank you for your
Thank you.
moderation. Thank you.
You're welcome.